Hi guys, I'm Genevieve, founder of Lyons Property Mentoring. Today I want to quickly run through my personal thoughts on what the property market's up to for the remainder of this year. Now we're past the halfway mark for 2016, it's clear that 2015 was a great year for savvy investors in places like Sydney and Melbourne, where prices grew between 10 and 20%. So I'm often asked if this is going to happen for this year as well. So with investments in several Australian markets, here are my personal thoughts on what's going on around the country. The first topic we need to cover that's stealing the show right now is obviously Britain and their decision to leave the European nation, and in turn what this does to the Australian market. Now, no one obviously has a crystal ball here, and there's a lot of talk coming from both sides of the coin regarding what this means for our economy and the property market. But given that Australia is a safe haven due to our stability and our economic growth, this may attract overseas investors that would have once put their money in the UK but now don't want to due to the present volatility there. Plus, we've already seen huge jumps in the Australian share market, which may also have investors move their money from shares to property for the time being. While there are still micro markets within these cities where you can find good growth, on the whole, I expect that we'll see softer growth as these markets reach the end of their growth cycle. Prices are overtaking household stability, with many areas now seeing property prices over the $1 million mark, so I expect that these areas will stay flat for some time now. In terms of the rental market though, there's a lot of new high density and outer development happening in Melbourne, which is affecting the rental growth yield. On the other hand, Sydney, we're seeing a shortage of rental accommodation, so you would think that rental prices would start increasing in Sydney. Perth and Darwin are driven by the resource sector, and with that in a bit of a downturn at the moment, there's nothing to drive growth here. Looking ahead to Hobart and Adelaide, these cities don't really have the fundamental economic and demographic drivers in place that would have any real growth right now, so I believe that they'll remain steady. With the Sydney and Melbourne markets hitting their peak, educated investors know to stay away while at the top of this cycle, unless you can get your hands on an entry-level blue-collar property priced below market value for positive cash flow. Now, with investors looking for the next boom, my sights are set on Brisbane and the Gold Coast. These areas were hit really hard by the GFC and floods and haven't quite recovered, but there's early signs of that changing. So you can still buy cheaper properties in these areas than you could pre-GFC, and sometimes even cheaper than you were to build them. Good rental yields are also making positive cash flow investments here. It's important to remember that there are microeconomies in each of these markets, so you always need thorough research and evaluation before you ink any deal. Mining towns, on the other hand, are always risky and not a great way to start a foundation for a portfolio. Ideally, you want to buy them early and sell them before the market retreats, okay? Do not hold onto them. I haven't seen any regional areas with any significant industry or infrastructure in the pipeline to encourage huge growth right now. There'll always be towns that outperform and surprise you, but it's difficult to pick them ahead of time. To be safe, I always recommend buying within a 1-hour commute or a 30-kilometre radius of any capital city because it's the most consistent predictor for growth and stability. Please keep in mind that these are my personal opinions on the market, and obviously nobody has a crystal ball. But if you want to learn more about investing, head to lyonspropertymentoring.com and sign up to the training ring there. Happy investing!